Welcome back, everyone. Today on the Joseph Carlson Show, we're going to be going over 5 different high-quality compounding machines. These are companies that are incredibly high-quality, growth-oriented companies, and they're ones that I believe are a buy today. Now, some of these are in my portfolio, some of them are not, and they're 5 of the companies that I believe are the most interesting and compelling investments that we can access today. So I'll be going over all 5 of them, giving a quick investment analysis on each, and reviewing the thesis. Now, we also have some other news to get into. First of all, Buffett retired. He announced that he's retiring at the end of the year as CEO. Greg Abel's taking over as CEO of Berkshire. Stock is down a little bit, but we'll review his incredible track record. And Buffett also, in his shareholder meeting, basically called all of you babies, wimps. He kind of trash talked all of us. We'll be going over why he kind of made fun of everyone for panicking over the past month, so we'll be looking at that as well. And then we had the surprise news on Sunday evening that shook Hollywood. President Trump is apparently implementing a new 100% tariff on the movie business. All movies made or produced outside of the United States and then imported to the US. We'll be going over logistically how this would work, the grounds on which this tariff is being created, and why overall this is a terrible idea. And then finally, we have Mark Zuckerberg on a podcast explaining how Meta AI is at the forefront of creating artificial intelligence, especially with relationships. He goes over how he thinks not enough people have real friends. They only have 2 or 3 when they need 15. And so he's filling in the gap with AI girlfriends, AI relationships, AI therapists. We'll be looking over this incredible clip and reacting to it in this episode. Now, as we jump into the 5 quality companies that are worth looking at and potentially buying today, I first want to take a look at my portfolio and just give you an idea of how my investments are doing. Some people will suggest that I'm just showing off my portfolios to brag. And while it's fun to show off when things are going well, like they are, keep in mind that I've also shown both my portfolios during all times, even when the market's doing poorly, even when these portfolios are going down. Now, both the story fund and the passive income portfolio here are doing exceptional. If we look at the story fund, we can flip over to that. We have $319,000 of total value, $120,000 of that being gains. If we look at the story fund in and of itself, this is what it looks like. It's now at a total of 98% returns against the market, which has 41% returns. Now, if we look at both of these on a compounded annual rate of growth, this is what it looks like. The passive income portfolio, since its lifetime, has returned 9.92% CAGR. Story fund is at an 18.66. Again, most of that is from Netflix. It's just been a huge winner. The S&P 500 comparatively is at 7.2. And the QQQ is doing the worst at 7.09. But you'll notice that the QQQ and the S&P 500 are actually closely matching each other. I believe this is because the top holdings are looking more and more similar. But overall, the reason that I highlight this is to show that what we're doing here is not just for fun. I do think picking stocks is super fun. Building positions in companies and watching them grow over time is really rewarding. So I do genuinely just enjoy doing this. It is very entertaining. It's very fun. I think everyone should be investing, picking out at least a few individual stocks. You can have the majority in an ETF, but having a few individual stocks really puts you in the mind frame of ownership. I think it's a really good thing to do. It's really rewarding. But on top of all of that, we're also doing this to outperform the market. Every company that I buy is with the goal of outperforming the S&P 500 and the QQQ because I consider those my opportunity cost. Those are the benchmark in which I have to outperform. And I believe that we can continue doing this through solid stock picks. The first one of which may not surprise you, it's Amazon. Amazon, I believe, is a strong buy today. Now, as we look at Amazon, I've gone over this company so many times that I'm not going to rehash the entire investment thesis. We all know that Amazon is at the forefront of every major technological innovation in current day. They have a robotaxi business called Zoox. They have a satellite internet business called Kuiper. They have artificial intelligence with their own models. They have AI infrastructure with AWS, and they have IT infrastructure with AWS. The company's in online retail, it's in advertising, it's in streaming video. These are all important verticals that you want to be in, and they're expanding in more of them like healthcare. So this is a company where we know the investment thesis. They're in incredibly important businesses all throughout the world. They're kind of positioned as this ETF in all of these leading tech verticals. And the company has enormous opportunity, operating leverage, revenue. They have so many levers to pull so many opportunities to work with within their own business. So overall, the thesis for Amazon is very strong. But one thing that I think is worth mentioning is with Amazon in particular, there's a new law introduced, or in fact, it was kind of removing a law that will benefit this company dramatically, and we're already seeing the benefits. And that law was the de minimis tax exemption. This law is now revoked. Trump removed it. It's one of the things he's done that's helping out our companies, specifically Amazon. Let me explain for a second just what this law was. The de minimis tax exemption was basically a law that said, if you bring something into the United States that's of small value, let's say you buy like a souvenir that was a couple $100s from a foreign country, you fly back to the US, well, you don't have to pay taxes or port of entry fees or tariffs on that item. The whole purpose of this law was to exempt small things coming back to the United States, particularly like souvenirs, things that you might just buy and you don't want to have all that red tape. You don't want to have those taxes associated with it. So this is a law that Congress intended for that type of usage, for these little situations where people go to a different country. You might go to like Japan, you might buy some small items or souvenirs there, you bring them back to the US, and you can circumvent the normal port of entry fees or the tariffs because of that. That was the de minimis tax exemption. But then what happened was they raised the exemption to $800 from $500, and that caught the attention of Chinese retailers. There's some retailers like Temu and Shein that sold very inexpensive items that were shipped directly from China to the US. And they found out that they could use this law to their advantage. Anytime someone goes onto Temu or Shein, they order a product, because they're buying just that specific item or whatever it is, their little basket of order that's like $100 or $200, not $500 or $800, they could have that item sent all the way from China into the United States in a 2-week period and not pay any tariffs, not pay any taxes on the way. That was the de minimis exemption. That means that these companies, Temu and Shein, were having millions of transactions every single day from all these customers buying stuff directly from China and avoiding all taxes associated with it. Now, the way that Amazon works is quite different. Amazon doesn't ship stuff directly from China to you. They ship stuff in bulk from China to Amazon warehouses. They store them and they distribute them. So then when you buy them, you get it in 2 days. But since they're buying it from bulk in China, it's over $800. They don't have the exemption. So Amazon is paying these taxes and tariffs while Temu and Shein are not. And then Temu and Shein have super ultra cheap prices compared to Amazon. So this gave Temu and Shein an unfair advantage over Amazon. And now this is all coming to an end. Here's some reporting on this. This was in preparation of Trump ending this tax loophole.
Some signs that Americans could be paying more for low-cost overseas products. Bloomberg reporting discount Chinese retail app Temu appears to be passing on almost all the new U.S. import taxes to U.S. customers. The cost of some products more than doubling. It also says that fast fashion giant Shein is raising its prices in one popular category by 50% on average. This comes ahead of the Trump administration ending what's called the so-called de minimis rule.
Now, that report was a couple of weeks ago when they simply anticipated getting rid of this loophole, and it actually happened. The loophole exists no more, and this is trouble for Temu and Shein. Customers are already starting to notice the increased prices. We have TikToks going viral highlighting the frustration with how much Temu and Shein are raising their prices.
I was doing my nightly scroll through Temu and I noticed something concerning. You see, the whole point of shopping on Temu is that everything is like disgustingly cheap, right? But a lot of these products, especially the ones that aren't being shipped from the US, aren't very cheap. So while I look it up, maybe I just have unrealistic expectations. No, Temu and Shein are both raising their prices. Which kind of sucks because even though I'll never buy a PC off of Temu, places like AliExpress actually have some pretty good deals on PC parts. Now there's two explanations for why the prices are increasing. Either they're starting to pay the kids that are making the products, or it's tariffs. I think it's the second one.
Here's another one going over the product being shipped and noticing the large charge added to the shipment.
Shein babies, listen up. This message is for you. If you have recently placed an order off of Shein, be prepared for it to come DHL. Also, be prepared to pay your import duties now, which mine was $32.57.
So you can see that they're now attaching a duty fee or an import fee onto the end of the purchase. So you get your cart full of stuff in Shein or Temu, you go to purchase it, and then at the end, you're charged with this duty fee. And that's, in some cases, double the cost of your entire order. And this is impacting their business. Temu and Shein are in panic mode, wondering what to do in this situation. So far, they've been a beneficiary of a very unlevel playing field, where Amazon's getting hit with tariffs and taxes that they're not. And now that's ended. Now remember that these companies, Temu and Shein, were talked about as being one of the biggest competitors to Amazon. These were the Chinese rivals taking market share, the companies that were the top downloaded apps, and they were doing so unfairly. Amazon was still thriving even though these companies were competing in many of their verticals unfairly. But now that the playing field has been leveled, a lot of that traffic, a lot of those customers will go back to Amazon. Because if you're already paying a high price, if you're already paying the normal price that everyone's paying, you may as well get the 2-day shipping. So I believe this is one more simple incremental advantage for Amazon. Of course, this isn't the investment thesis in and of itself. Like I said, Amazon is at the forefront of every vertical. This company is on track to become a mammoth in the future. I believe Amazon could be worth $3, $4, $5 trillion down the road. My belief is that the company is currently worth around $260 per share. So I see a significant gap between where it trades and its intrinsic value. And that's why I'm comfortable holding this one as a top position. Now moving on to stock number 2, we have Meta. This is one that I don't currently own, but this one is a buy today. What I've seen from Meta, and as I observe with many companies, I try to have an overall gauge of how the qualities are developing. If the company is becoming qualitatively weaker, or if it's becoming stronger. If the moat is getting more narrow and shallower, or if it's getting deeper and wider. With Meta, what I've seen is this company continually become stronger and stronger, not just with the numbers they're posting, but with the fundamentals, the qualities, the moat, the territories that they're going into. Meta is really well positioned for the future. Their last earnings report was moving from strength to greater strength. When we match the qualities of the company, the framework that they've created for global communication, and we do that against the numbers also look really compelling. Revenue continues to grow at a fast pace, 19% year over year on a trailing 12-month basis. The majority of the revenue is still advertising, but it's very diversified advertising. It's a really resilient form of advertising. Their usage continues to go up. The family of daily active people using at least one of their platforms every single day continues to increase around 6% year over year, now to 3.43 billion users. They don't really need to increase this. They already have enough users. They have ways of monetizing and getting further engagement from their already astronomically huge user base, but they're increasing it nonetheless. When we look at the free cash flow, this is another bright spot for Meta. Meta has continued to grow free cash flow per share. It's now at $20 per share. Back in 2020, it was at $7. So it's over doubled. One of the things that I'm watching with the company that I think we should keep an eye on is the stock-based compensation compared to the free cash flow. But even when we look at it now, although it's high, it's not insignificant, they are still growing the free cash flow faster than the stock-based comp. Now, they may have some temporary impact on free cash flow as they invest in artificial intelligence and they do those large CapEx investments, but we'll still see strong growth on the earnings per share while they're making those investments. The earnings per share on a trailing 12-month basis grew 47% year over year. This is incredible growth. Meta's at a 23-24 forward PE ratio, 22 trailing, and a 21 PE ratio based on 2026's earnings estimates. That's all relatively reasonable, if not low. To put this in context, if we look at the DCF calculator on Qualtrim and we put Meta through a single scenario, we assume that it's going to grow its earnings at 15% for the next 5 years, which is strong, but I think reasonable assumption. That means that the company, if you assume a 22 PE ratio, very low reasonable PE ratio, the company will have a 13.5% compounded return for the next 5 years. That's not astronomically high, but it's still a relatively attractive return for a company of this quality. And I believe there's a strong possibility of them outperforming these assumptions. In number 3, we have an enterprise software stock called Salesforce. This is one that I do have a position in because I believe the company's meaningfully undervalued. Salesforce is going through one of its lows, and that's not something unusual with this stock. If we look at the past 5 years, for example, notice the volatility in this one. It's one that trades around with great volatility. It gives you the impression that the business may be unpredictable or the cash flows are incredibly volatile, and that couldn't be further from the truth. While the stock price is all over the place, and the stock is a high beta stock trading up and down $30, $50 in the order of a couple months, the revenue of the company is overall very consistent. In fact, it's one of the most consistent revenue lines you'll see in any stock. This is the same for every major business segment. So they have many aspects to their company. All aspects are growing. Even when we're looking into the future, the total performance obligations is when other companies sign contracts with the intent to use Salesforce's cloud products. That's showing growth over time as well. It's not slowing down. So we can extrapolate growth into the future. When we look at the financials, for example, the free cash flow of the company, you also see very consistent growth over time. In fact, Salesforce's free cash flow per share has grown 33% over the trailing 1 year. Now, looking at the free cash flow again, you'll also notice that they're getting their expenses under control. When we look at the free cash flow versus their stock-based comp, so the company pays their employees a lot in stock-based packages, you'll also notice that the stock-based comp has been flat since 2022. In fact, it's kind of going down over time as the free cash flow continues to accelerate in growth. So the free cash flow margins of the company are getting higher and higher. If we look at the valuation of the company, historically speaking, the free cash flow yield over the past 5 years right now is one of the highest free cash flow yields, making this company at one of the cheapest points over the past half a decade. So the company's price has gone down, the valuation has improved dramatically, the company's still seeing steady revenue growth, and even with all of that going on, you'd suspect the company's facing some existential crisis, but that's not the case. They're at the forefront of agentic technology, they're still heavily diversified, they've always faced many competitors, but Salesforce is an extremely robust platform, really difficult to replicate at their scale, and they have a lot of pricing power. Now, finally, the biggest reason that I highlight this company as a buy today is when we look at Salesforce, Microsoft, which is very similar to Salesforce in many ways, posted one of the best earnings reports I've seen over the past couple of years. Now, Salesforce moved up a little bit after that, but I believe that Microsoft's report should have moved Salesforce up a lot more. It showed that enterprise solutions are doing well. It showed that agentic technology has great demand. It showed that all of these type of aspects of Salesforce are still selling and making money. Microsoft proved that in the report. I've referred to Salesforce in many cases as mini Microsoft. It's very similar in a lot of ways to their business model. So with Microsoft having that great of a report, I believe that Salesforce should be meaningfully higher today. When I look at this company, I believe Salesforce today should be a $330 stock. That's where it should be trading. Right now it's at $275, so I believe there's a decent gap. The number 4 high quality growth company, a compounding machine to buy today, is the Dutch lithography machine maker, which is ASML. This company always has some fear surrounding it. The latest one is that China has made some chip that's similar to ASML. When you dig in a little bit deeper to those scenarios, the progress with China, you highlight the many faults in those type of comparisons. For example, they're not as good and they can't build them at scale. They're missing a lot of the technology. As of right now, ASML still holds a commanding and definitive monopoly in this technology. They are years ahead. They're a company that's so unique and offers a product so valuable that they can charge hundreds of millions of dollars per product, plus an enormous amount to upkeep them and service them. ASML has reached an all-time trailing earnings per share, while the business is traded down to $700 per share, making this company on a relative and total basis more attractive than it was prior. Right here we have the trailing PE ratio of the company. You'll notice the only times that it's really ever traded this cheaply was in the midst of 2022 when every stock was cheap, everything was trading down. It got there for a little bit in 2023, but there's many cases where this stock traded at much loftier valuations. Right now, the company's trading at the lowest point it has in the past 5 years. ASML is likely doing a ton of buybacks right now, trying to support the stock price, buying out shareholders that want to exit the company because they have a ton of cash. This company is highly free cash flow generative. They use that money to buy back shares, especially when the shares are cheap. So I expect to see decent earnings with this company, earnings per share growth, and the stock price move meaningfully higher. Now, the number 5 stock that I believe is turning into a quality compounder is one that may come as a little bit of a surprise because I haven't highlighted this one really at all, but I've become increasingly impressed over time. The company's Duolingo. Now, this one may seem like a weaker company. A lot of people have their opinions on the application, whether or not they like using it, a lot of anecdotal and various opinions on it. But keep in mind, those are the same type of opinions and anecdotes that you get for companies like Spotify and like Netflix. Some people say, I don't like Netflix shows, or I don't like Spotify. I'd rather have Apple Music. Very similar situation with Duolingo. And similar to those companies as well, this one works with millions and millions of people. It's a subscription company. It's a bit of entertainment, but it's mostly focused on the educational side. It has vast appeal to a large group of people wanting to learn about different subjects. Now, this company, I'll just say right at the forefront, the metrics look optically expensive. So anytime you have a company that has a 200 trailing PE ratio or 150 forward PE ratio, it's easy to just rule that out as a value investor. But one thing that I'll note is PE ratios are based on forward estimates of earnings, and earnings are very difficult to judge for companies that have massive growth, that have margin expansion, and especially those that have operating leverage. This is where many companies look expensive while they're actually cheap. That's like Amazon 10 years ago. Amazon 10 years ago had a 100 plus PE ratio, but that was actually a decent time to buy it. So when I look at this company, I'm looking at a couple things with the valuation. One of them is I pay attention a bit more to the price to sales. The price to sales is high, but not unreasonable. It's currently at a 27, and the company is growing at a very fast rate. For example, last quarter, the revenue grew 37% year over year. So even at a 27 price to sales, when you're growing 37%, 38% year over year, you cut that price to sales down fairly quick. A year or two and it's much, much lower. So some of that's being priced in. If we do a quick comparison, this company's growing, again, last quarter, 37%, and it's at a 27 price to sales. If we look at it compared to Palantir, Palantir is currently at a 100 plus price to sales. So roughly 4 times what Duolingo is. And this company's growing at 36% year over year. So Duolingo is roughly 4 times cheaper on a price to sales basis and growing its revenue a little faster. If we do another comparison, just to kind of wrap our heads around this, we can look at CrowdStrike. This is another subscription-based, highly recurring revenue company. It also trades at a 28 price to sales. So companies that are in this ultra premium growth rate, they command a much higher price to sales than the majority of companies simply because the growth, resilience, and outlook of the businesses. Now, what caught my attention looking at this company is, first of all, I love companies that have a stable install base, deeply embedded, and reoccurring revenue in nature. When I look at my positions, companies like S&P Global, like Intuit, companies like Netflix, companies like Microsoft, these are all subscription-based, highly reoccurring revenue companies. Even Costco, the retailers that I prefer, are reoccurring. Amazon has Amazon Prime, the membership that's reoccurring. I love that business model, and I think it's highly investable. And this company certainly has that. In fact, the stock price just jumped after their last earnings. Look at this massive jump. It went up 389 to 500. When we look at their Q1 earnings report, we look at the user metrics. The actual paying subscribers went from 7.4 million in Q1 of 2024 to 10.3 million, a 40% increase year over year. This is the reason that the stock is jumping. More and more people are clamoring to use this subscription-based product. Now, in terms of what they educate people on, the big thing they started with was language. So learning different languages, for example, you could jump on and learn Spanish or French or whatever you wanted, and they have all these fun courses to go through to learn that language. But then they released new courses. One's based on music and one's based on math. So now at virtually any age level or difficulty, you can go in and learn math, which I think is great. But they're also expanding into different verticals as well. One of the ones that they're demoing right now is chess. So they're going to try to teach people how to become better at chess because they know that has a huge amount of interest. As they release more and more verticals, they should be able to retain and gain more subscribers. So although I'm not invested in this one, it's become very intriguing. It's one that I'm going to be watching and see how this one develops. So there we have the 5 high quality growth companies that I believe are all strong considerations to buy. Now moving on, we get to the shocking news that happened over the weekend. If you were paying attention, you knew that Berkshire Hathaway was having its shareholder meeting, typically where Warren Buffett eats some peanut brittle and drinks some Coca-Cola and answers questions and provides his wisdom. The Oracle of Omaha has done this year after year for like 50 plus years, and it's become a ritual to go there and listen to it. Now, I didn't go to it this time, But I did see the news that Warren Buffett shockingly announced his retirement. This is something that came to a surprise to many, including me, and even a surprise to people he worked with. In fact, Greg Abel, the one that's taking over Berkshire at the end of this year, didn't know in advance that Warren Buffett was going to announce his retirement. So Warren Buffett said that he thinks he's done a decent job and he's out. He's putting in the towel. He's moving on. Who knows what he's going to move on to, but he basically framed it like saying that at the end of this year, he's retiring as CEO. He's not going to do the day-to-day operations, but he might hang around the office, maybe offer a little bit of advice here and there if necessary, but he's confident in the future of Berkshire. He's built this into a fortress, an impenetrable, indestructible fortress. That's what Berkshire has become. And they highlighted that with their giant cash pile. Now, the cash pile was central focus of the Berkshire Hathaway shareholder meeting. Many people wondering, why do they have so much cash? What do they see in the future? And continually, they explained over and over again that this huge cash pile by Berkshire is not because they're forecasting some near-term destruction to the economy. It's in fact an asset to Berkshire. They view it as stability for the company, as a fail-safe, as something where they never have to rely on a different company or a different bank, a different lender ever again. They are fully self-sufficient. So the reason that Berkshire has so much cash is simply a way for them to always survive and thrive through any environment. They always protect the shareholder first. Now, there are some other things that Warren Buffett did throughout the meeting that were, I think, a bit comical. One of them was the highlight over the past month, the chaos that happened in the market over the past month. Warren Buffett, didn't you see? Didn't you see how stocks went down 10% in 2 days? Trump is tariffing everything. There was panic in the air. Stocks were selling down. Investors were becoming very discouraged. Many investors sold. They sold out of their stocks. They switched strategies. Didn't you see everything that goes on? And then we have Warren Buffett basically saying to stop being a baby, to man up. If you're a woman, to woman up. Stop acting like a child. Stop being so easily scared. Take a look at how he phrases this.
30, 45 days, 100 days, whatever you want to pick up, whatever this period has been, it's really nothing. There's been 3 times since we acquired Berkshire that Berkshire has gone down 50% in a fairly short period of time, 3 different times. Nothing was fundamentally wrong with the company at any time, but this is not a huge move.
He says, literally, that this is nothing. That the last 45 days or 50 days or whatever it is, it's nothing.
That's part of the stock market, and that's what makes it a good place to focus your efforts if you've got the proper temperament for it, and a terrible place to get involved if you get frightened by markets that decline and get excited when stock markets go up. I don't mean to sound particularly critical. I mean, I know people have emotions, but you got to check them at the door when you invest.
This is really what separates great investors, legendary ones, from poor investors that have bad outcomes. Legendary investors do not let sentiment, news, media dictate their emotions on the market. They buy quality companies that they know will persevere over long periods of time. And you see this in Buffett's commentary. He's going to be this way till the day he dies. He will focus on the fundamentals of company, and he uses panic in the market as opportunities to buy. So once again, the legend himself is highlighting it there, and I love the commentary. I think it's great what Warren Buffett's doing. Now, moving on, we get to some news here. That this is a bit of a shock to me. I've gone on their record saying that I think that Netflix and other streaming services are relatively insulated from the tariffs, and then Trump decided that's not the case. President Trump just posted this on Truth Social Sunday evening. Quote, "The movie industry in America is dying, a very fast death. Other countries are offering all sorts of incentives to draw our filmmakers and studios away from the United States. Hollywood and many other areas within the United States are being devastated. This is a concerted effort by the other nations and therefore a national security threat. It is, in addition to everything else, messaging and propaganda. Therefore, I am authorizing the Department of Commerce and the United States trade representatives to immediately begin to process and instituting a 100% tariff on all movies coming into our country that are produced in foreign lands, We want movies made in America again. That's the post. So far, we haven't received any more details on this. There's a lot of questions of how this could technically be implemented, what it really applies to, whether or not it's any foreign movie that's being showed in the US, whether it's licensing movies from streaming companies, whether it's just US studios that do the production outside of the US, or so on. There's a lot of different ways that this could be implemented, but I first want to just take a look at the central premise of this great threat to our nation. President Trump is arguing here that it is a threat to our national security that other countries are producing movies. That's what's going on here. That's the logic. And I just think it's important to consider that, the premise of this tariff. Remember that every tariff has to be premised on the basis of an emergency, because these powers are normally not given to the president. The power of taxation is given to Congress. So in order for the president to use tariff power and implement these dramatic, incredibly huge taxes, 100%, he has to do it on the basis that it's an actual emergency. The emergency in this case is that other countries are producing movies. Other countries are producing content. So movies that come from the United Kingdom or Canada, for example, that is a national threat to the United States. The companies in Australia that are producing movies, a national threat to the United States. Even the United States studios that presumably film outside of the US to get filming throughout New Zealand or through Europe to have different scenery, those are national security threats to the United States because they're producing content outside of the United States. In South Korea, the South Korean films like Parasite, presumably again, are a national threat to the United States. It's all propaganda that they didn't film this South Korean film with South Korean actors, South Korean producers in South Korea. They didn't film it in the United States. So it's now a national security threat. This seems very difficult from a logistics standpoint to argue that any of this is a national security threat. Now, President Trump was asked specifically about the tariffs on the movie studios. This was the answer he gave.
Yeah, sir. The movie tariffs, what they've done is other nations have been stealing the movies, the movie-making capabilities from the United States. And I said to a couple of people, what do you think? I've done some very thorough research over the last week. And we're making very few movies now. Hollywood is being destroyed. Now, you have an incompetent, grossly incompetent governor that allowed that to happen. So I'm not just blaming other nations, but other nations, a lot of them, have stolen our movie industries. And I'm saying, if they're not willing to make a movie inside the United States, then we should have a tariff on movies that come in. And not only that, governments are actually giving big money. I mean, they're supporting them financially. So that's sort of a threat to our country in a sense, and it's been a very popular thing. I can tell you, movie makers love it.
Now, he mentions over and over again that other countries are stealing the US's movie-making capabilities. And I believe the research he's referencing shows that places like the United Kingdom offer big tax incentives. They try to make it frictionless and easy for US studios to produce their content over in the UK. And they do this for all sorts of reasons, to employ people, to build up communities, to have different reasons to visit there. There's all different downstream impacts of that. So to some extent, he has an argument that other countries are incentivizing US studios to film outside the United States. Now, on top of these other countries offering strong incentives and making it frictionless, we have places like Hollywood, and California, and New York City also having their production go down every single year. And part of the reason why is they make it so difficult to do business in those states. They have tons of regulations, tons of taxes. It's very difficult and expensive to produce content in Hollywood and New York City. And the government there, like he says, hasn't done a good job at keeping people producing content there. There's also technological advancements. For example, if you want to make it look like you're in LA, you no longer need to be in LA. You can have studios that have clever lighting and CGI, artificial intelligence, mimic the vibe and look of it without actually being there. So the moat of filming in LA and having that type of vibe and silhouette and atmosphere, that's also being eroded with technological advancement. The same thing can be said for New York City. Many films that are based in New York City aren't filmed in New York City because you can mimic the look, the city, and the feel through clever uses of technology. So all of this has led to a lot of production moving outside of the United States to Canada, a lot of post-productions being done outside of the United States. You have cheaper labor, less regulations, and technology that can close the gap. So there is some truth that Hollywood has been increasingly producing content outside of the United States. And President Trump sees that as a threat. He sees it as a problem. He wants everything done in the US. So the solution to this is to slap on a tariff. Tariff the problem away. And I believe, unfortunately, for President Trump, for the United States, for our media entertainment companies, that this can cause far more problems than it solves. For example, part of the premise of the original tariffs that Trump implemented in April 2nd, the entire premise was the huge trade deficit. He looked at countries like China or South Korea or Vietnam, and he said that we buy far more from these countries than they sell to us. That's a trade deficit. We're getting a ripoff. It's because of trade barriers. And so we're closing in that deficit and these countries ripping us off. Well, in the case of digital products, companies like Microsoft, Apple with subscriptions, companies like Netflix, Disney, Peacock, HBO Max, the United States exports far more of these digital services than we import. In fact, it's a massive export surplus for it. So instead of having a trade deficit with Hollywood and streaming video, we have a massive trade surplus. And this is where I believe this has far more potential to be heavily damaging towards the United States, towards our entertainment industry, and broader, our entire digital industry. So far, the tariffs have been somewhat contained to physical goods. And that's where we have that trade deficit, buying cheap goods from other countries. But now President Trump has shifted it from physical goods to now digital goods. He said that this is going to be a major focus. Now, again, we have a huge surplus with digital goods. If other countries decide to have a reciprocal tariff on US media and entertainment or digital subscriptions, they have far more to gain from that than we have to tariff movies made outside of the United States. Because again, we sell far more to them than they buy from us. So if other countries start tariffing Netflix and Disney Plus and Amazon Prime memberships and Google subscriptions, that opens up a massive problem for the United States. So this shift in broadening the scope of tariffs opens the United States up to a vulnerable point of other countries tariffing digital subscriptions that so far they've withheld from doing. Now with Netflix specifically, this company up until today was on the longest win streak in its entire history. It was up for 11 consecutive days. This is what that win streak looks like. From the low point of $855 up to $1,160, this company was on a roll. Of course, this news is going to knock it down a bit today, but it's only down 1.7%. When I look at Netflix overall, this doesn't change what I believe is the intrinsic value of the company over time, but I think it does have the potential to snowball into a bigger problem. I think the biggest problem for Netflix is now they're becoming a direct target for other countries to have a reciprocal tariff. Netflix is by far the most exposed country to revenue outside of the United States. For example, if we look at a breakdown of their revenue by geography or by region, we can see that only half of it, in fact, less than half of it, comes from within the United States and Canada. We have a lot of it coming from Europe, the Middle East and Africa, Latin America, Asia Pacific. That's the majority of revenue. If these territories start to implement tariffs, it could hamper Netflix's growth. It could hamper their potential. So right now, with what little we know about this news, I'm not making any big judgments so far. I continue to hold my Netflix. I think the stock will be fine in the long term, but it's something I'm going to be watching for. Now moving on, we get to this interview by Mark Zuckerberg, where he highlights his views on the adoption of artificial intelligence, how it's being implemented in society, especially on those more interesting topics like AI friends. You have therapists and girlfriends that are now artificial. This is where society's going. And he shares some thoughts on this, specifically with friends. Listen to what he says here.
Already one of the main things that we see people using Meta AI for is kind of talking through difficult conversations that they need to have with people in their life. It's like, okay, I'm having this issue with my girlfriend or whatever, like help me have this conversation. Or like, I need to have this hard conversation with my boss at work. Like, how do I have that conversation?
A lot of people have looked at this and said that that's kind of scary, that people are getting advice from AI. I actually don't think that's too scary. I think it's normal for people to look up information and get some ideas of how to answer or how to handle different situations better. For example, it wasn't unpopular to look up in Google What do I do in an interview? What if they ask me this? What's a good response to this? How do you handle these type of questions? People tried to get answers to that before artificial intelligence. The only thing that AI is doing is just giving it a lot more directly and a lot more succinctly. So this is not exactly, in my opinion, new behavior to try to look up how to handle unique situations. The big differentiator here is that artificial intelligence is far more specific. You can literally describe the exact scenario you're going through. It'll give you a pretty logical response to it. It'll explain the different benefits of behaving different ways or different ways to handle things. And I really don't think that's that big of a problem. In fact, I think it might help a lot of people that don't know what to do in certain situations get some better context or ideas.
One thing just from working on social media for a long time is there's the stat that I always think is crazy. The average American, I think it's fewer than 3 friends. 3 people that they'd consider friends. And the average person has demand for meaningfully more. I think it's like 15 friends or something, right? I guess there's probably some point where you're like, all right, I'm just too busy. I can't deal with more people. But the average person wants more connectivity, connection than they have. So there's a lot of questions that people ask of stuff like, okay, is this going to replace kind of in-person connections or real life connections? And my default is that the answer to that is probably no. I think I think that there are all these things that are better about kind of physical connections when you can have them, but the reality is that people just don't have the connection and they feel more alone a lot of the time than they would like.
Now, I agree with his overall sentiment. I certainly don't believe that these AI relationships are going to entirely replace human friendship. I think we're a ways off from that happening. But they could supplement having something to express ideas with and getting feedback. I certainly think it's going to play a role there. But it's one thing that he says early here that I think just hits me the wrong way. And I don't know if it's just me, but it sounds a little weird to refer to, he says most people have 3 real people that they consider real friends, but they have demand for much more. They have demand for 15 more. Referring to the need to have more friendship as demand is such a Mark Zuckerberg robot CEO official way of saying it. It's such a product way of saying it. Like you're a product. It's like if you go to a person and say, hey, I have 3 real friends that I consider, 3 people I consider real friends, but I have demand for much more. So would you like to become supply for that demand and help the ratio of my supply demand imbalance with friendship? Mark Zuckerberg says I can use far more friends. It's just a bit weird. It's a bit weird referring to your friendships and the lack thereof as having demand for more that's not fulfilled yet. Now, other than that, I kind of agree with the overall sentiment. I think that these tools have the potential to be really helpful. I think a lot of people get scared of any change, any new thing, any dynamic change, but having more information, more tools to get feedback, I think can be a good thing. Are there going to be cases where it goes wrong? Where people become unusually attached to AI and, form deep, meaningful relationships like the movie Her? Of course, those are going to be highlighted. They'll be interesting to see. But for the majority of people, I think that overall, this can be a positive thing. That's going to be it for this episode. Hope you enjoyed. See you in the next one.